Okay, welcome to Accounting 2300. We're going to finish up Chapter 6. And what I think I'm going to do is actually go ahead and finish up all the activities. I'm going to kind of streamline it and just work through the activities and not flip back and forth to the notes in the front part. You can read through the notes, and if on Monday you have questions, we can go through the questions. Plus, you can hold open the notes while you're watching me work the activities. I think the important thing is to make sure we get through all the activities, and I'm going to go ahead and finish it up in this video so that we have the majority of Monday to go over the review rather than leaving something on Monday for us to do that might kind of slow up the review. So with all that, let's go ahead and get started. Now I didn't notice before, but there was one class where I didn't actually fill out this top part, the average cost method. So this will be kind of going over again what I already did in class for some of you, but one class I'm going to do the average cost, and then we'll work into now. All the classes need the FIFO and LIFO. So let me go ahead and do this. So beginning inventory, if we look up here in the information, beginning inventory, there were 20 units in beginning inventory at a cost of 4 per piece, or 80. The net purchases were 55 items. Total cost of 350. So that gave us a total of how many items could we sell in total? What we started with, beginning inventory plus what we bought, 55 purchases, total of 75 items. We can't sell more than that. And let's see, this is 20 times 4 for a total of 80. So here, 430. Now remember, our inventory equation says what we start off with, beginning inventory plus purchases must equal ending inventory COGS, meaning ending inventory and COGS must total 430. And we can use that to our benefit. So it says here up top that we sold 50 units, right? So that's the COGS. Well, if we have a total of 75 units and we sold 50, well, that must mean we have 25 left over. So right now what we're going to do is use the 3 different methods to figure out the 3 different methods will come up with a different. So the 2 together for all 3 methods, the ending inventory and COGS are going to total 430. It's just that because the different methods count COGS differently, we're going to come up with a different split for average, FIFO, and LIFO. So let's go ahead and take first a look at the average cost. So how do we do average cost? Well, we focus on not that there are a bunch of different costs that we just lump them all together and create one average cost, but because there are different amounts of each, we just can't take the 4 numbers and average them. We have to do a weighted average. The weighted average is done, take the total amount available, or the total dollars available, and divide it into the total amount available. So here, what do we have? We have 430 by 75 units, right? 430 and 75. And that comes out to the nice round number of $4,733 per unit. Right? So how do we plug that in? Well, we know ending inventory, we've already calculated here, is 25. This is kind of just a redo. And we say we're going to multiply those by 5,733. And what do we get? We get $143 for ending inventory and $287. And remember, I said no matter which method we use, those are always going to total up to the $430, which this does, right? So if I look here and I say under the average cost, the split is going to be 143 for ending inventory and 287 for COGS. Now we talked about FIFO and LIFO, first in, first out, and last in, first out. And remember, first in, first out says however many units we sell, and in this case it's 50 units. What we're going to do is count down 50 units in the case of FIFO from the oldest units. Now we could remember that purchase 1 is not the oldest units. Yet we have to actually think of the list as this, with beginning inventory with 20 units. Yeah, 20 units and $4. So 20 units and $4 for a total 80. So when we start doing FIFO, we start off with beginning inventory and we work down until we get 50 units. So we use all 20 of this, all 10 of this, and 20 of that. And that's what we're going to do here. So we'll go down here and write that out exactly that way. So calculate FIFO. We start at the oldest inventory, which is the beginning inventory. We're going to take all 20 of those units at a cost of 4 apiece, $80. And we're just going to go until we get to 50 units. So all 10 of purchase 1 at $5 for $50. And notice we don't use up all of P2. We only use 20 to get to the total of 50 items. And this is $6. This is 120. So here our cost of goods sold is $250. Now I could just go straight ahead and say, well, I already know what my goods available for sale is. I could just say 430 minus 250 must be ending inventory. Or I can actually count the inventory. So what do I have left? So if I count up, so remember counting down is what we get to COGS. What's left is the ending inventory. So we had all of P4, 10 units, $8 a piece, 80. We had all of P3 that we didn't touch, 10 units, $7 a piece, 70. And then what did we have? In P2, we didn't use 5 units of $6.30. So this came out to 180. And number of units left is 25, which makes sense because we said there were 25 units in ending inventory. So here, if we do the FIFO, what do we get? We get ending inventory is 180, and we get the COGS is 250. So you see already there's a difference depending upon the method you use. There's a difference in what ends up being the split between inventory and COGS. Okay, so LIFO goes the other way. It starts with the most recent, the last inventory item in. So that would be starting off with purchase 4 and then working our way up until we get to 50 units. So let's take a look at that. So we'd start off with purchase 4. Those are 10 units, $8 a unit, a total of $80. P3, we're going to use all of that. $7 unit, 70. P2, we're going to use all of that. Now you see that's 25, 35, 45. We only need 5 more. So this one's $6, so 150. And so for P1, purchase 1, we're only going to use 5 of purchase 1, and that's $5 a piece, and that's 25. So here, cost of goods sold, still 50 items, is going to be 325. And again, we could just take 430. You just take 430 minus 325 and get ending inventory, or we could count it. So what's left in ending inventory? Well, all of beginning inventory, 20 units at $4 a piece, or 80. And what did we have? We had 15 left. 5 left. 5 left in purchase 1 at $5 a piece and 25. So 25 units. You notice in each case, it's 50 units of COGS. It's 25 units of ending inventory. It's just how do we count the numbers? So here, this is 105. So this is our breakdown here is going to be 105 and 325. So you notice very different numbers across. Okay, so that's our LIFO, FIFO, and average cost. Let's use that information in a different context. So if we look at activity 4, we're going to say, remember we said we use LIFO, and I explained that we use LIFO in rising inflation situations. Or that tends to be the case with companies. They choose that because it matches the most expensive, the highest costs with their revenue, so they don't end up having too high a tax burden. So what we're going to do is do a little bit more information about that. Now, this seems like a bunch of different stuff. In rising times, prices, right? In times of rising prices, determine the following. FIFO, LIFO. In terms of declining prices, determine the following. Well, let's take a look at a very simple situation. Let's say you have 2 inventory items, right? Beginning inventory is a $1, you only have 2 items and they're 2 different prices. The first inventory item, beginning inventory, is a $1 item. You buy it again, so purchase 1 is $2. So that's a rising price. It went from $1 to $2, right? So under FIFO, and under LIFO. So remember, under LIFO, we start off at the newest item first and work backwards, right? So if we sold one item, this would be our COGS, and this would be what's in the inventory. FIFO starts at the oldest item and works down, or works, forward in history. So this would be our COGS, and this would be our ending inventory, right? Increasing prices, LIFO, FIFO. LIFO starts off with COGS at the most recent item, and the rest is ending inventory. FIFO starts off counting COGS at the oldest item, and what's left over is ending inventory. So here, if I said in times of rising prices, determine the following. FIFO EI is, so under FIFO, EI is what? Higher or lower? It is higher, right? It's the $2 item. And COGS is the lower, the $1 item. Net income. Well, COGS are lower, right? They're lower than if it had been 2. So because COGS are lower, therefore net income, COGS being an expense, therefore net income is higher. And taxes, because net income is higher, taxes are higher. Let's look at LIFO. Let's keep the same framework. We're still working on this, except on this side. EI of the two items it's the lower item, right? It's the $1 item. And COGS is the higher. It's the $2 item. So net income, well, because COGS are higher, net income is lower. And because taxes, net income is lower, COGS are higher. I'm sorry, not COGS, taxes. Taxes are higher. So you will get a question on saying, in the times of rising prices or the time declining prices, figure out, and we'll look at an example here in just a minute. Let me just go and figure out this next one. So it just basically is the reverse. Whatever you knew for LIFO here is going to be FIFO for this one, and you'll see why here in just a second. So in the times of declining prices, if our beginning inventory was a $2 item and we bought it later at $1 under FIFO and LIFO, so you can see this is declining prices, right? This is declining prices. So this is still going to be under FIFO. That's still going to be COGS because we start at the oldest item, and this will be ending inventory. And this is under LIFO, COGS will be the $1 item, and ending inventory will be here. So under this, EI is lower, right? $1. So you can see these are going to match. This is going to be higher. Net income is going to be lower. Net income is going to be lower. And taxes are going to be, I messed this up. Because net income is lower, taxes are lower, right? If your profit is lower, your taxes are lower. Here, your income is higher, your taxes are higher. And with EI and under LIFO, ending inventory is going to be the higher item, right? COGS are going to be the lower item. Net income is going to be higher. And taxes are going to be higher. So here, if we take this information and we think about it or apply it, December 31st, the end of the first year of operations, the management of the Busby company is trying to decide whether to use FIFO or LIFO method of measuring inventory. It determines that the LIFO method would produce the lowest asset amount. Now, what do they mean asset amount? They're talking about ending inventory. So determine if costs have been increasing or decreasing. So if we go here and we look at these two sections, right? LIFO under rising prices it says the asset would be lower. So here, LIFO, under rising prices, EI, ending inventory, would be 1, but under declining prices, EI would be 2. So which one is lower? Because it says under LIFO, they would produce the lowest asset amount. Well, it looks like it must be increasing, right? Because if we take a look at, LIFO for the two different types, prices are going up and prices going down. And we say ending inventory and COGS. Under rising prices, right, it's 1 and a 2, and it's the reverse for over here. So it says which LIFO, they're saying the LIFO method that produces the lowest asset amount is under rising prices. Okay, based on this trend in costs, the trend here is increasing prices, right? We've just determined that. Which method produces the higher COGS? Which inventory method produces the highest COGS? So based on rising trends in cost. So if we look at, so now, whereas before in this part of the question, we were just looking at the LIFO side of it. Now it says, let's look at the rising trends. So of these two, these are the two methods during rising prices, FIFO and LIFO during rising prices. Which one produces the highest COGS? Well, LIFO produces the highest COGS. Because it would be COGS of $2 between the two. Based on the trend in cost, which inventory method produces the highest net income for the year? Okay. Which one produces the highest net income? So remember, we're still talking about the rising prices. Well, net income here is going to be higher because the COGS under FIFO, are lower, therefore the expense is lower, therefore net income is higher. So this is going to be FIFO produces the higher income because COGS are lower, which results in net income being higher. Based on this trend in costs, which inventory method produces the highest cost of goods available for sale for the year? Well, that's a bit of a trick question, right? Because goods available for sale is what? Is beginning inventory plus purchases, right? That is goods available for sale. So remember, I guess how you have to think about it is that, remember, goods available for sale, I guess it's this. Maybe a better way to say is this. Remember, beginning inventory plus purchases equals ending inventory plus COGS, right? So under FIFO, that would be COGS of 1 and ending inventory 2. Under LIFO, it would be COGS of 2 and ending inventory 1. But you notice both of these are 3, right? Beginning in inventory and purchases, it doesn't matter how you split it up. It's going to have to equal ending inventory COGS. So no matter which way you go, whether you use LIFO or FIFO, ending in inventory plus COGS equals 3, right? Equals 3. And no matter how you split it up, beginning inventory and purchases, this also has to equal 3. That's just the way the inventory equation works. So based on the trend, which inventory method produces the higher cost of goods available? Well, neither. They will be the same. So they will be the same. Because all we're doing is splitting up EI and COGS two different ways, but they both equal beginning inventory plus purchases. Okay, let's move on to the next one, activity 5. Lower of cost or market. So this is a situation, you notice a lot of times we've talked about, why do we take returns when we don't know actually how much returns there are? And and like from accounts receivable, if we don't know exactly who or how much is not going to pay their bill, why do we go ahead and take the hit? Well, because as we've said before, in conservatism, in accounting, under conservatism, what we say is that if we think or have information that we know that something bad to the accounts has happened, we go ahead and do it right away. We don't do anything positive. We always take the negative conservative approach, saying if something is likely to have happened or we have information has happened that reduces the value of the company, then we need to go and put that in there so that when we're displaying an accurate picture to the investors. So this is exactly that situation again. If for whatever reason we find out that our inventory is worth less than what we bought it, we need to go ahead and mark it down. And that could be for a lot of different reasons. Perhaps you decided to, buy a whole bunch of a certain type of product, and then the company releases a new version of the product. Well, what you bought now is sort of outdated. And you'd probably say, oh, well, they didn't tell us they were going to release a new version. Now my version is old and I've got to discount it, something like that. Or, maybe it's not as trendy now, and maybe the market price has gone down or whatever. And that's what we talk about here. We will record whichever is lower, the historical cost, or what if the market says there's a price that's lower than that, then we'll record that. So here we've got maple sleds, 15 units at a cost of $1,200 per unit, so a total of inventory of $18,000. Assume the current replacement cost of the inventory is $1,100 per unit. Well, already you can see that the market is saying that we paid $1,200, but nowadays the market is saying it's $1,100 per unit. What entry, if any, is required? So what we're going to say is, well, if our historical cost was $1,200 per sled, and that the new market is $1,100 per sled, well, what we need to do is we have to say, well, we got to mark it down. We're going to have a loss here of $100 per sled. So what does that mean? We have 15 sleds, and so that's going to be a total loss of $1,500. What does that look like in the journal entry? The journal entry is going to say we're going to take a hit to inventory. Our inventory is less. So that's going to be $1,500. This is a credit to inventory. And where is the debit? The debit is going to be into COGS. It's going to be an expense. It's as if we sold off part of the inventory for nothing, essentially, or we sold it at a loss or something like that. But we're going to take the hit to inventory. Obviously, to inventory reduces the value of inventory. And where do we take that hit? We take it into COGS, which is an expense, which hits our revenue this period. Instead, assume that the current replacement value is $1,525. Well, that's higher than the $1,200. What entry, if any, is required? Well, we already know our historical cost was $1,200 per, and the market is $1,525. You might say, oh, well, let's mark it up. Our inventory is worth more. No. I mean, you could charge more when you're selling it, but it's not going to be, you're not going to be cost. So what is this? The historical cost is still less than the market, so there is no change. No change and no loss. So there's going to be no journal entry. Now, for whatever reason, let's just take the hypothetical. If you did this before, right? You said, okay, we bought it at $1,200 and then it went down. We found out the market went down to $1,100. And then later on, you found out it went up to $1,525. Can you mark it up? Well, no. Once you've marked it down, or can you remark it up to $1,200? I mean, those are some of the questions. No, you can't. As soon as you've marked it down, that's where it stays. once you've marked it down, it stays at the new markdown. You don't, or I guess a better way, you just can't mark up. Can't mark up. There's too much moral hazard in that. Because partly, what is that? Remember, we've got this historical cost rule, right? And it also kind of messes with our revenue recognition. Okay, so that's a fairly straightforward thing. That's not that hard to figure out, but it's one of the smaller things we're dealing with. Okay, well, we just have 2 items left. Let's move on to activity 6. Okay, ending inventory using the gross profit method. Okay, so I'm just going to say up front, this is a little bit fiddly. This is basically saying there's a different way to figure out your ending inventory. First of all, notice it says estimating. If you don't have all the information, and the situation here that we have is, let's say there was a fire, and it destroyed the inventory, and it destroyed some of you didn't take a physical count, and you destroyed some of your inventory, so you can't take a physical count, and so now you need to kind of recreate the situation. Well, we're going to rely upon our income statement, our revenue minus expenses equation, and we're going to rely upon the COGS equation to figure this out. So we kind of got to use it both. So what happens? It destroyed the entire inventory. No physical count taken since the December 31st of the previous year. The company's books showed the following balances at the date of the fire. So we got a bunch of stuff. The company's records show the prior year it made a gross profit of approximately 25%. So let's talk a little bit about the word gross profit. So like if you have something that costs $10, right? And it cost you $6 to buy it. Well, what does that mean? It means this part, that's your cost of goods sold, right? And this other part is your gross profit. So using these numbers, we would say COGS are 60%, right? And gross profit is 40%. Because this is the total price. This is the COGS. And therefore, gross profit is the difference. So you can see total price is made up of 2 things: how much you paid for it and how much money you made, right? The profit and the wholesale price goes into the total price. So when they tell us the gross profit was 25%, so if we take this now and say, okay, the gross profit was 25%, well, what does that mean for COGS? COGS must have been 75% of whatever the cost of it was, right? So here, this is actually wrong. I think what they're asking for is they're asking for to determine the COGS percentage, because obviously they've just given you the gross profit percentage. So it says here the gross profit percentage, and there's no indication that the percentage cannot be considered to have continued. So we're just assuming 25%. So the gross profit percentage here, well, we just kind of looked at it. And another way to say it is it's COGS percentage is 1 minus the gross profit percentage, right? So if gross profit percentage is 25%, COGS is going to be 75%. So what do we need to do? Well, we need to take a couple of steps to figure this out. The first thing we need to do is we need to go ahead and figure out what our net sales are. So sales are 180K, right? And then we're going to take away less returns and allowances. And you notice we had returns allowance of 1.4. And did we have any discounts? I'm just going to write it in here because that's the normal process. And we didn't have any discounts. So our net sales is going to be 178.6. Okay. Now, if this is my total sales, right? So total sales, remember we said total price. This is looking at one item, but we can also think of this as being for total sales. If total sales is 178.6, what is the COGS part? Well, the COGS is just going to be 178.6 times 75%, right? If this is the total amount that we got, our COGS is going to be 133,950. I'm going to go ahead and write it out because 0.95 is getting a little fussy. Now, what do we do with that? Well, we need to now go and do, before we do the thing that's going to get us ending inventory, we need to figure out one other thing. We need to figure out net purchases. So we're going to start off with purchases, and those are 130, and minus purchase returns and allowances. So I guess I should say these are sales. Purchase returns and allowances are 2,000 minus purchase discounts. Purchase discounts, which are, I don't see any discounts. And here's the thing you're probably going to forget time and time again. Remember, we add freight in. So add freight in. And that was 6 or 1.6. So this is net purchases. Total amount of 129.6. And now we can plug it into our COGS equation. Our COGS equation is beginning inventory plus net purchases, not just purchases, net purchases equals goods available for sale minus ending inventory. Now this is our unknown equals COGS, right? The whole purpose was to figure out what is ending inventory because our records are destroyed and the building is destroyed. So beginning inventory was 40,000, right? Beginning inventory was 40,000. Now we just calculated net purchases here, and I'll write it out, 129,600. That gives us goods available for sale of 169,600. This is our missing information, right? We don't know this, but we know COGS because we calculate COGS right here, 133,950, right? So we can do this algebraically. You can do 169,600 minus this equals this. And what you come up with is this number is going to be 35,650. And that is going to be ending inventory. So you notice we had to come up with they gave us gross profit. We had to come up with the COGS percentage. In order to apply that COGS percentage, we had to come up with net sales. We had to figure out net sales and then apply the COGS percentage. In order to do the COGS equation, we had COGS correctly, but we needed to figure out net purchases to be able to plug it in. The other numbers, this number was given, this we calculated. This is just an addition, and this we calculated. That allowed us to find out the missing bit of information. So it says 35,650, and I say that's the amount that was destroyed, right? What if 2,000 was saved from the fire or out on consignment? How much would inventory? Well, that just says 2,000 of it wasn't destroyed. So if we're saying 35,650 was the amount destroyed, or at least that's our calculation, and we say, well, oh, hold it, 2,000 was on assignment, or we actually recovered 2,000 of it, well, that means, okay, not the total 35, but 33,650 was destroyed. Okay, I think we're doing pretty well. And like I say, because we're not in class and not taking questions, just make sure you go back. You have the ability to go back and watch the video. Because I'm just going to talk through it once. Okay, our last bit is activity 7, and this is inventory errors. So I will just point out that we've got two different things. We've got a single error in a single year, and then a single error in multiple years. And I will just point out that this will be on the exam. This will not be on the exam. I'm still going to cover it because I need to cover it. But if you want to kind of tune out when I get to this, I'm just going to do it quickly. All I'm going to do when I get to here is I'm just going to fill it out. But I'm going to explain this first one. So what happens essentially when you have an error in inventory, it has a carryover effect to the next year. But over time, and in this case, in 1 year, the error affects the accounts for both years, but then it clears itself out, and things are good going forward. And it basically is just a splitting situation. You've got the wrong ending inventory and COGS in the wrong year, and so therefore those things are thrown off a little bit for one particular year. But then, if you make a correct count the next time around, that error kind of washes out. So what happens is at December 31st, 2021, right, ending inventory ABC was overstated by 8,000, meaning it was 8,000 more than it was actually should be. So here we assume beginning inventory was correctly reported, net purchases was correctly reported, therefore these two added together was correct. What we have here is ending inventory was high by 8K. So what does that mean? Remember, these two together have to equal these two, right? So if we over-reported ending inventory, that means we under-counted COGS, right? Because these two fit together. So if we overcount one, we undercount the other. So what does that mean? It means ending inventory becomes beginning inventory of next year, right? The ending inventory of 2021 becomes the beginning inventory. So if we were already overstated at the end of this year, we're going to be overstated at the beginning of this year. Now, assuming that net purchases is correctly counted, what happens? Our goods available for sale are overstated by 8K. And then in the second year, if you actually count the ending inventory correctly, you're going to have what? An overstatement by 8K. But you notice you understate COGS by 8K 1 year and you overstate COGS by 8K the next year. So net income kind of fluctuates a little bit between those 2 years. But then you notice that because ending inventory, if I had 2023, right? If I had 2023, the beginning inventory would be okay. So you would have a fluctuation in some accounts here, but then it washes itself out. And then going forward, as long as you continue to keep counting inventory correctly. So what happens? In 2021, revenues are okay. The expenses are here. COGS is the expense. The expenses are down by 8K. Therefore, net income goes up too high. What also happens? Ending inventory is our assets. So on the balance sheet, assets are too high. Liabilities, as far as we know, are the same. But equity is high. Why is equity high? Because net income passes to equity, right? Because net income goes into the statement of retained earnings, goes into ending retained earnings, goes into equity. So equity would be high by 8K. On 2022, revenues, once again, they're not telling us anything happened to revenues, so we're just assuming they're correctly counted. But now expenses are higher, right? The COGS are higher here. Net income is going to be lower. Assets are actually okay now, right? We counted it correctly. So ending assets are okay. Liabilities are okay. And equity basically offsets. Normally it would be down, but it offsets this equity. It brings equity back to balance, right? This down offsets this so that equity is actually back at its correct place. So that is the, well, I guess we got a little bit more here. So the single error in a single year will be on the exam, but not this next one. So here's the last bit of this. Single error in a single year, but which year? If you are told that the current year's beginning inventory is overstated, the beginning inventory is overstated by 10,000, are you in the first or the second year? Well, it's pretty obvious. This is the sort of framework. If the beginning inventory is overstated, it can only have happened because in the first year, the ending inventory was overstated, right? Because an error, most of our errors are going to be our count of ending inventory. So the error itself is ending inventory. So in the first year, ending inventory is going to be incorrect. And in the second year, beginning inventory is going to be incorrect. So here we already know it's the second year, right? How did you know? Well, we knew because we looked at the chart. How does this affect the current year's financial statements? So if we looked at this, the second year, in other words, here, this is second year, sort of like second breakfast, right? Revenues, the expenses would be up by 10K. The net income would be down by 10K. Assets would be okay because we're following this pattern, right? The second year pattern. Ending inventory, liabilities. And then because it's the second year, even though it was net income down, that hit to equity, or that change to equity, brought it back into balance. Okay, so that's the part that could be on the exam. And now I'm going to explain the error in multiple years, and that will kind of be where we end up. And we're doing pretty good on time. Okay, so what do we have here? Ending inventory for ABC was understated by 7,000. In 2021, it was understated by 7,000. In addition, in 2022, ending inventory was overstated. So we've got ending inventory understated, and then ending inventory overstated by 9,000. So what we're going to do is we're going to look at the effect of the first year overstatement, right? 2021 and 22. And then we're going to look at the effect of the second one. In other words, they clear out, right? But they're not in the same year. So we're going to look at this, and then what we're going to do is we're going to match up the combined effects. So you can see this is already filled in according to this chart, right? According to how this works out. Ending inventory is overstated. COGS are higher by 7K. This ending inventory here becomes the beginning inventory. Therefore, goods available for sale are understated, and therefore COGS are understated. That follows the pattern of up here. So we have the same thing, but starting in 22, we have overstatement here, right? And the rest of it coming through. So if I look here and I say, what is the combined effect here for and remember, we're looking at 2022. So we're looking at this column and this column. So we have -7 and nothing. So that the total here is going to be -7K, or maybe I'll say down 7K. Here is 0 and 0, so there's 0 effect there. Here it's down 7K. Here it is up 9K. And here the offset is, you notice that we've got a sort of a reinforcing effect. We're down by a combined 16K. Right? So what happens? This is what happens, I guess, if we extend it out to this whole thing, is that we have the revenues. Once again, since we don't have any information to the contrary, those are all going to be okay. And same with liabilities. That's all okay. What happens is the expense, net income, assets, and equity. So here we're up by 7K, right? We're down. So I'm reading down this line, right? We're if expenses are up by 7K, that means net income is down by 7K. Our assets are down by 7K. And our equity, well, our net income, right, is down. So the reason why we do this internal column is because 2021, there's only one thing going on. That's the first error. 2023, there's only one thing going on. That's the second error. It's 2022 where the errors overlap. So that's why we had to do this central column to see, okay, we had things going on in the first error and things going on in the second error. And so we created a combined 2022 to see what was the combined effect of those two errors. Because 2021 is just being affected by one error and 2023 is just being affected by the second error. So here we're reading down this column, right? So it's going to be expenses are down by 16K and net income therefore is up by 16K and assets are up by 9K and therefore equity is going to be up by 9K. And here in 2023, we're just reading off of this column now. Expenses are up by 9K. Net income is down by 9K. Assets are now okay because ending inventory is okay here, right? And liability is okay. And this ends up, the combined effects here all wash out, right? What do you get? You get a down by 7, a down by 7, an up by 16, and a down by 9. So in other words, you have a down by 7 and a down by 9. Well, that's a down of a total of 16, and you have an up by 16. So that's what it washed. And I guess I should have mentioned that it was down 7 here, but net income, this was down 7, but up 16, which resulted in up 9. And then you have a down 9 versus an up 9, and then that balances out to even. Okay. Well, we kept it close to 45 minutes. I kept it to close to one class. Well, I did keep it to one class. So hopefully it all goes well. That's all of the activities, I believe, right? So you can finish up the activities, and what we'll do is I'll take questions on Monday. I mean, I'll take questions by email anytime, but if we have in-class questions or any of these things we can go over, and then we'll spend the majority of the class on an exam review so that you're up to speed. Okay, good luck, and I will see you on Monday.